Today I'm sitting down with Dan Passerelli from Market Taker Mentoring. And if you've ever wondered what trading looked like before charts, apps, and electronic execution, this one's for you. Dan came up the hard way, walking onto the Chicago Board of Trade and later the CBOE just to watch the pits like it was a live-action movie, then literally knocking on doors, handing out resumes, and getting a floor job for basically lunch money. But we don't just do the war stories, we get into how market makers think, what being a market taker really means, and why strategies like covered calls, cash-secured puts, and the wheel strategy are getting so much attention right now. If you've ever felt like options are a foreign language, this is the episode that starts making it click. Here is my conversation with Dan Passerelli.
All right, everybody. I'm here with Dan Passerelli from markettaker.com, Market Taker Mentoring. Dan, thank you so much for being here.
Eddie, I am super excited. Thanks for having me.
Oh, my pleasure. My pleasure. So I am really curious about your trading strategies. We're going to talk a lot about that today. But before we get into that, I really want to know about you. So tell me how you got into trading. What was the spark for you? How did you become interested in the markets?
Oh, yeah. Well, I'll tell you, I went to college in Chicago to get a finance degree. And the exchanges were pretty darn close to where I went to school. And so there were some days when I had gaps between classes or whatever, and I would go to the exchange to sit in the visitors gallery and just kind of watch, you know.
Which exchange?
I would go to the Chicago Board of Trade, and I would go to the Chicago Board Options Exchange.
Okay.
Those are the closest ones to me. And yeah, I would just sit there and watch and wonder. And then after school, I was like, well, there's a lot of things I could do. I'm young once. I'm going to give it a shot. And I went and I literally knocked on every door of the Chicago Board of Trade building, handing out resumes, and got a job making $9,000 a year.
Yep, that's what sounds like a beginner's Wall Street job for sure.
Yep.
When I was started as a stockbroker, before I had my license, I had just graduated with an MBA, 23 years old, $200 a week. With a phone like duct taped to my head, dialing for dollars back in 92, 93.
Yes.
It was crazy.
Yes.
It's crazy. So where'd you go from there? So you got this job.
Yeah. So I got a job as I was a runner on the floor, which is basically just a lackey they give paper orders to and say, here, go give this to Charlie and, don't screw it up. And then, I asked a lot of questions of the other clerks and the traders and learned more and more and kind of worked my way up a little bit. I ended up being one of those clerks that stands on the side of the pit making hand signals, and then became.
So I was a clerk also on the New York Mercantile Exchange in the summer, starting at age 17. So I'm familiar. So I'm just curious, were the trades being cleared? Were they cleared electronically? Was every trade being hand processed still?
Yeah, back then it was all writing down on a card, rip the duplicate copy off, and I'd have to go and turn that into key punch and all that.
Right. Same thing on the Mercantile Exchange. They did have a database, but there was the duplicate page, and my job as a clerk was to make sure every trade was what the other side agreed to, the other side of the trade. So whatever my brokers, whatever they were buying or selling, I had to make sure it was correct in the database, a big old green screen back in the old days. Yeah, and a lot of hand signals and phone wires everywhere. And now what markets were you working in?
Yeah. So, when I first started, the first couple of years, it was the commodities, and I worked grains for a little bit. I worked bonds, the treasury complex for a little bit. When I finally worked my way up to be a trader's assistant, that was mostly in the bond options.
Wow.
And then ultimately I got moved over to the Chicago Board Options Exchange for equity options. And, then from there, went and knocked on a bunch of different doors and found myself a backer.
A backer. So, and the backer, what does that mean? Does that mean that you were trading his money for part of the profit?
Yeah. So man, I was a clerk for a long time, like 4 years. And, a good 2 years of that was being a trader's assistant and having to know what is delta, gamma, theta, and vega were, if everything was punched
Oh,
in right,
yeah. Options a lot more complicated than straight up futures,
Yeah.
like on commodities.
Yeah.
And then plus the treasury market is pretty complicated to kind of understand what's going. Let's like, on the New York market, they were trading heating oil and crude oil. It's pretty straightforward. Supply and demand. I mean, which the treasury market is too, but it's a little harder for people to wrap their head around how the banking system works and the treasury market. It's still to this day. I mean, and all these years later, it's it's a bit of smoke and mirrors.
Yeah.
And then options, options on futures. Futures, in a way, are options, are they not?
Yeah, I mean, the whole derivatives complex, a derivative on a complex product, treasuries.
Right, right. Go ahead. I'm sorry, I interrupted you.
Oh,
So you got a backer. You got a backer.
oh yeah. So, so since I basically knew everything, I mean, I had to know everything that the guy I worked for knew. I knew how to trade by then. I mean, you spend enough time around anybody and doing anything, you learn something. So yeah, I knew how to trade. So I knocked on doors. I got a backer. It was Steve Fawcett, who's kind of well known in certain circles, even besides trading. And yeah, got a backer and ended up trading in some of the equity pits on the Chicago Board Options Exchange, and did pretty well. Had a good long career there.
Awesome, awesome. And then from there, did it become electronic?
Yeah. So, oh my gosh, yeah. I don't have to tell you, you lived it also. But we went from yelling and screaming and filling out cards with a pen and paper to here's a computer tablet, here's a stylus. Everything became electronic. Kind of started as a hybrid type system, where some was electronic and some was paper.
Right.
But yeah, then it just all the open outcry disappeared.
And when did that happen?
Oh gosh, it seems like forever ago by now, but
2005, somewhere in there, a little later, maybe earlier.
I think a little earlier. I want to say like
Okay.
2000. I mean, I was on the floor until 2003. And,
Okay.
electronic trading was one of the impetuses for me leaving the floor. So yeah, I think it really kind of all started around maybe 2001, if I remember correctly.
Wow. Okay. Now, what I'm curious, pit trading options on stocks. So was it like, explain to me how that works? If there's a pit, are there like a handful of stocks that the options are traded in one pit, or were you doing more of like index options, or what were you doing?
And the CBOE, it could be either or both. I was in equity pits. I spent most of my career in, we called it the Ford pit, like Ford Motor Company.
Okay.
That's just because that was the biggest stock options name that was traded in there. But I
Okay.
traded in that pit. I mean, there was probably 30 some stocks that traded. I personally traded Ford Motor Company options, SBC, or AT&T now. What else? Carnival Cruise
Right.
Line.
SBC Communications. Right. Go ahead.
Carnival Cruise Lines, USA Networks, bunch of other stuff.
Cool. That was a wild time working on the floor If it was anything like New York, I know you guys had a good time.
Yes, it's pretty fun. I'll tell you that.
We don't have to get into that level of detail, but I'm fully aware. So, okay, so you had a backer. So were you trading your own account or it hit like a joint account? How did that work?
Yeah, back then,
Were there such thing as locals? So like on the NYMEX, they had, my dad was a local. He only traded his own account where most everyone else were working at a firm and they were trading customer orders.
it was pretty few and far between of people who were trading their own money. There were some guys in my pit that did trade their own money. But with futures, from my observation, a lot of futures traders go home flat at the end of the day, right?
There are position traders. I would call it more, I think it's both. It's like day trading and swing trading. Or that's how it used to be. My dad would carry positions and the other traders that I work for, they would carry positions, but some of them were seasonal based on, because they were trading oil futures. So it was like a weather based, seasonal based spread trading, that kind of thing. So there was, I would call it swing trading, but there was also day trading, guys picking off. One guy stood next to a guy who worked at a giant firm and they were a huge buyer, and who knows what their card they were showing their deck, like what trades, where the stops were, you know what I'm saying? There was a lot of that going on too.
Yeah, but with options, there were like 9 or 10 of us in the pit. And when a big order came in to get filled, I mean, it was going to get filled. So you ended up trading a little bigger, and anything that you traded in the options, you had to hedge with the underlying. And so you end up using a lot of margin. I think it was tough for there to be people trading their own money. You ended up being pretty limited.
Right.
Whereas if there was a pretty well capitalized individual in my pit, I mean, I would have the ability to trade far more than that person because I had all of the company's money,
Right. Okay. So hedging, yeah, I would imagine, if you have to hedge your positions with options with the underlying. Okay.
Yeah. So, I mean, even though I was getting like half the profit and splitting it with the company, I could trade 10 or 20 or 50 times bigger than I could have if I was trading my own money. So it ended up working out.
Right. Okay. So after the floor,
yes,
you went to screen trading. What changed?
Well, interestingly, that's the common path. I wish this podcast was like, 10 hours long. I could tell all my stories. I probably still wouldn't have enough time.
We'll just have to do another one.
Yeah. So, when things started getting pretty tough with the electronic trading and such, there was a guy that I trained to be a market maker, and it just didn't work out for him. And so he started teaching classes for the exchange, but he was this like military badass. He's like an Army Ranger, did triathlons, Ironmans, and so he got a phone call from some, paramilitary company and said, we need you to go stand on a roof and, with a rifle and make sure nobody shoots Dick Cheney. And so
Wow.
Seriously, real deal, like send him off to the Middle East. And so he's like, listen, I'm going, they're looking for somebody to replace me. Do you want my job teaching options? And I was like, not really. There's those that can do and those who can't teach. Why would I want to do that? And he's like, well, look, maybe consider trying it out. So I was like, well, all right, I'll try it. And I tried it. And for the first time in my career, my professional career, like there's a day I was walking down the street and a guy on the street stops me and says, hey, are you Dan Passerelli? I was like, yeah. And he goes, listen, I've been watching your webcasts from the CBOE where you teach classes, and you really helped me. Before I couldn't make it work, and now I get it. Thank you. And
Wow.
something that day just clicked. And I was like, yeah, this is what I feel is maybe my calling. I don't know. It's what I want to do.
That's
Yeah.
cool. Awesome story. It must have made you feel good for one.
Yeah.
And like you could actually make a difference, help people figure it out. And options are very challenging, to say the least. I mean, there's so many strategies, so many ways to think about it. So you started teaching for the exchange, and then from there,
Yeah. From there, I got hired by this like big deal trading firm. Like they traded, I forgot, it's something like 5% of the option volume in the world, just this one
wow,
firm. Yeah. I mean, it was like the stuff you'd see on Billions. And they hired me because they needed an educational arm. And so I went there. I helped them set up a brand new brokerage firm and, did a lot of work there. But then from there, I was like, I'm going to do this on my own, and just branched out and started Market Taker Mentoring in 2008, which is the perfect time.
oh
Yeah,
wow,
perfect timing, right?
yeah, totally. A lot of people trying to figure out what to do.
Oh, yeah, yeah, yeah. Yeah, actually, like people always say, oh, geez, that had to be a terrible time to start it. But I mean, you're right. Like it actually was kind of a good time to start in a lot of ways.
Definitely. I mean, when people are losing their jobs, I hate to say it, they start looking at the stock market more
Yeah.
as an opportunity, even if it's just temporary, to make money. So, I mean, I can see it even happening right now. It feels like there is a little bit of a surge in new interest in learning to trade.
Yep.
So you've been teaching through Market Taker all this time. It's a very unique name. How'd you come up with the name?
Well, having spent most of my career, almost all of my career before that, as a market maker, where I was the person who was saying, hey, here's the bid, here's the offer. What do you want to trade? I'm making the market. I mean, the rest of us are people who take that market. We're market takers. And I think that that's kind of an important way to look at it, because we, as market takers collectively, everybody who's not a market maker, we're always paying the bid ask spread in one way or another. Like, we can get good at middling markets, but we still pay a small amount in what we call slippage.
Right.
And that's one of the costs that you have to overcome. So market takers start a little bit in the hole with that cost and commissions, which are a smaller cost. So it's really important to understand edge-based logic and strategies that not just overcome that disadvantage, but give you an advantage in your trading.
Okay. So let's talk about strategies. You're teaching now options exclusively?
Yeah, I mean, options exclusively is what I do and one of our coaches do. We do have a futures guy who handles our futures classes and that kind of thing. So at Market Taker, we do options, we do futures, even trading equities and indexes as well. But
So I want to know, what is your favorite options strategy?
well, you know, they're like my kids. Do I say which one of my kids is my favorite? Not when the other one's around. Um,
That's the right answer.
right. So, I kind of go back and forth. I mean, look, every option strategy, the reason why there's so many of them is because one is the best one for a specific situation. So, I mean,
Right.
I have used all of them. I will continue using all of them. I've been moving just a lot in the direction of covered calls and cash secured puts.
It's so funny you mentioned that. because I've been looking at like the wheel strategy and the cash secured puts quite a bit myself as a way to just generate extra income. So, which of those are your favorite? Let's talk about that, and why are you leaning towards that? What are you seeing as the advantage there?
So, I mean, as far as covered calls or cash secured puts, I mean, I look at them as one and the same. It's the wheel strategy, like you pointed out.
Okay, just so maybe give us your description of what you would call the wheel
Oh,
strategy
right, right.
to somebody who might know very little about options
Yeah.
who's watching.
Yeah, so there are two option strategies we've been talking about. There's covered calls where if you own shares of a stock, you can maybe use options to squeeze a little more juice out of them, if you will. And you would sell a call option so that the amount that you sell it for, you get to keep. And then there's, managing that position because you could get assigned and sell the stock, which you may want to do or you may not want to do. If you sell the stock and you don't have a position in a stock, but maybe you'd consider wanting one, or maybe you think the stock's not going to fall, you can sell a cash secured put, which is when you sell a put and you keep cash in an account in case you get assigned. When a stock goes down below the strike price of a put and you're short it, you might get assigned, which means the person who owns the right to sell the stock to you sells it to you. So you might end up buying the stock. Yeah. There's kind of a lot to actually, there's so much to it that
Yeah.
I just
No, you're good. People watching this will have a little bit of a clue,
yeah.
hopefully.
I just
Here's a question that I don't even know the answer to. So to sell puts, you need the highest level of options approval. I guess it's called level 4 options approval, right? If I remember from my brokerage days. Um, do they consider margin when they approve you for level 4? Like, can you sell puts more than the cash if the stock was put to you if you have a margin agreement in place?
oh boy. Yeah, there's a lot to talk about with this. Oh
Okay.
gosh, it's weird. Like
I know I went to a really kind of a challenging technical question because you call them cash secured. So it means that if somebody's putting the stock to you, you have to buy it, or you're being assigned to you, you have the cash to buy the stock.
yeah,
But do they include, let's say you only have half the money, but you also are fully approved for margin. Do they count that?
right. Oh,
Or they won't even let you take the position if you don't have enough in cash?
yeah. So that depends on a couple of factors. So you would think that everything would be universal. We're like, okay, selling puts, level 4, straddles, level 3. But it's not. It depends on the brokerage firm. Some brokerage firms won't even let you sell puts at all, which is absurd. Uh, you know,
Hmm. They don't want to risk that you don't have the money.
yeah, but then why do they let you buy stocks, or why don't they make sure you have the money? Because, and when I say that, there's two ways to sell puts. There's one where it's totally cash secured, which means, and it's kind of a funny name. I just mentioned, I just finished my third book, which is all on covered calls and cash secured puts, the wheel strategy. Yeah.
Oh, wow.
That's
Okay.
coming out in April of 2026, end of April. And I talk about that in the book. Like it's a kind of a dumb name, cash secured put, because what you're doing, you're not securing the put, you're securing the potential future purchase of the stock. And so
Right.
the brokerage firm, like they make a distinction between selling cash secured puts and just selling puts, naked puts. If you sell a cash secured put, your broker will take the amount that if you get assigned, this is the amount of money you need, and they'll set it aside for you.
The buying power that you need in your account. Okay.
Buying power. And then because of that, there are some brokerage firms where that might just be level 2. Like, yeah, I mean,
Oh, really? I didn't
yeah,
know that. And so naked put might mean you don't even have enough cash in the account. Firms will let you do that.
yeah, and that is where margin comes in. Then you're
Mm,
very margin.
okay. 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 So the word naked put refers more to having a margin
Yep,
agreement. And okay. All
yep,
right. That's a new
yeah.
distinction for me. Okay. I get it. I get it. So tell us why it's you're leaning more towards these, and you've written a book on it now.
Yeah, I mean, after having traded like every option strategy known to man, including just the really complex ones, why am I moving towards this? I think it's two things. I think one is because I've just got increasingly interested in sort of fundamental analysis, like picking better stocks, which when
Okay.
I started my career as an options market maker, that was not in my skill set at all. But I got more interested intellectually in that. And that's probably because of reason two, that, getting older, I'm getting closer to retirement.
Whatever that
Whatever
means.
that means exactly. So yeah, I'll probably never retire. I just can't sit still, but so yeah, it's an excellent, I mean, in my opinion, it's an excellent way to lower your risk while outperforming the market, to trade the wheel strategy. And that's what I use it for, and just became so passionate about it over the last few years that, I mean, it's the main thing I trade, and I guess that's what prompted the book.
So I interviewed a guy a couple weeks ago. Very interesting the way he described the wheel strategy. So he's been he's been using the wheel strategy on Tesla specifically. And so the way he uses it is he thinks of Tesla as like his rental property.
Mhm.
And so when he's long, he's pulling rent out of the stock. And when it gets called away, and then he's just doing the cash secured put side, it's kind of the same thing. He's pulling like a weekly rent check out of it, which I thought was an interesting analogy. You have to be real. He just wants to accumulate it forever. It's kind of his strategy and be in the stock forever, or at least for the time being. Um, so you have to have a lot of. It seems like you have to have a lot of conviction around the underlying to make it really work and be okay when, I mean, like for example, I think Tesla was 490 this morning last I looked at it. Like 2 or 3 weeks ago it was 350, and it had dropped from 450 to 350. So it can be very volatile, and that's why you also get big options premiums. But what do you like? Do you like that analogy? And if that's a true analogy, let's assume it is. Do you like the analogy? And if so, what percentage annual return of a rental income is a not too pie in the sky?
All right, a lot to unpack there as well. First, do is that a good analogy? Do I like it? So sometimes that's a good analogy. There are different uses for the wheel strategy. They start with having one of two objectives. The skate objective, where, hey, I want to own the stock that I have. I'm going to sell a call and I hope it expires so that I get to keep that income. This guy calls it rental income. Fine, rental income. I get to keep this income and it expires, and then I sell another one and get to keep that. So that's the objective of skating on the option, which doesn't always happen. There's going to be some times when you have to buy it back and you'll lose money on the option. It happens sometimes.
Right.
But then there's also what I call the trade objective, and that's with the objective of trading into or out of a stock. So I own this stock. I bought it when it had a 8 PE ratio, and boy, oh boy, it's up 30% on the year. Now it's actually like a 20p ratio. It doesn't pay a dividend. I don't really want the stock anymore. I'm going to sell a call close to the money and hope I get assigned, hope I sell it. There's my limit order. And if I
Right.
don't get assigned, that's fine too. I'll just sell another one and take in more money until finally I do get assigned.
Right.
So those are the two broad categories of what you can do with it. So, is that rental income a good analogy? Sure, it's a fine analogy for some uses of the wheel, absolutely. But it's very versatile. There's so much you can do with it.
Right. I know. I mean, the variables feel
Yeah.
overwhelming. How do you manage all the different permutations? I mean, so like for example, QQQ. Some could argue, the best way to own QQQ is to dollar cost average. So you're buying a little bit every single month. And if the market goes down, so what? You're going to accumulate it at lower and lower prices. And historically, it just keeps making new highs. And as long as you're putting in a similar amount of money, let's say every month, over time, that can work very, very well for you.
Yeah.
It's a diversified portfolio, even though it's 80% or 90% tech, but
Yeah.
it still might be that changes over time. So how do you look at it
Um,
from that point of view? Or and like right now, what would be your favorite stocks to use the wheel strategy on?
oh gosh, yeah. Well, I mean, as far as the QQQ thing, yeah, there's definitely a school of thought that says, hey, I can't time the market, which I know by and large most people can't, and maybe nobody can. I would love to sit here and tell you I can do it, but it's hard for anybody. I mean,
Right.
so I think that does make sense, but you can do that in an even better way by just selling cash secured puts on it. Because then you're, in addition to putting in orders to buy when it dips, because buying dips, I think, is like a way that people like to do that.
Right.
When there's a dip and you get assigned on the put, great, now I own it. And if it just goes up, then okay, great, I get to keep the premium. So like that's a cash secured puts can be an excellent way to work a strategy like that. But as far as stocks that I like the wheel on, I mean, I do it in spiders. Apple and Amazon are ones that I've done just constantly. And it's funny, I'm looking at the stocks in my IRA here that I do the wheel on. And they all they don't all have, but there's a lot of different objectives being traded here. There are some just like Apple and Amazon where, yeah, hey, just keep taking the premium because options are typically overpriced. So there's an edge there. There's like MP Materials, which can be kind of a weird one to do covered calls and cash secured puts on, but that's kind of like the Tesla guy. You can get really excellent premiums when that stock pops.
Right.
So that's an unconventional one that actually works pretty well for it. Philip Morris, just because it's very underpriced, in my opinion, undervalued, I should say. Cash secured puts, I've got cash secured puts on that. I don't know. Lots of them. There's a lot of stocks that are good for the wheel.
Gotcha. Okay. I'm going to give you an example. Let's say an investor inherits 1,000 shares of Google. Okay. Doesn't the stock he's had it for a while now. He inherited it 5 years ago. And so his cost basis is the day he got it. So he has this huge capital gain in the stock, doesn't want to let it go, but wants to because it doesn't pay much of a dividend, would like to generate some more income out of it. So now we're talking about covered calls.
Yep.
What would be a good strategy to essentially pay yourself some kind of your own dividend in terms of covered calls? Which calls would you sell? How often would you sell them? With the goal, again, not to be, you really don't want to let go of the stock because it's giant capital gain.
Yeah. So that is why I had to write a book on this, because there's so many little nuances and caveats that come along with all of this. And I talk specifically about this use case in the book. Funny little story. I was under contract with Wiley for the book to write it to be 80,000 words. And when I first started, I was like, holy crap, how am I going to come up with 80,000 words? And then I got about like 2/3 through the amount of time I was allotted to write it. And I said, well, first of all, I asked for a little extension. And then second, I said, yeah, I can't write everything there is to know about covered calls and cash secured puts in 80,000 words. What's the maximum you'll take? And they're like, well, 100,000. So I got like right up to the line. Gosh, I feel like I could write a sequel to it. There's just so much to it. And I really wanted this to be like the Bible for covered calls and cash secured puts. So anyway, to answer your question, when you sell a call and you get assigned, like you literally have the obligation to sell those shares at the strike price. And so if your cost basis is really low, you probably, depends on where you live and the political winds at the time, though it's been very, very consistent for many, many decades, that you pay a capital gains tax. And that could be, I mean, if I buy a stock at 100 and sell it at 101, I pay $100.
Yeah,
you know?
But if you have it for 10 years, stock's up 500%.
Yeah. So you pay a massive capital gains tax. So there are a few things that you need to take into account there. One is you manage the trade and adjust it with the objective of trying to avoid assignment. And so that might be buying the call back early, maybe even taking a loss on it, rolling it up to a higher strike. That being said, you can't always avoid assignment. Sometimes a surprise.
Stock gets assigned before the expiration day sometimes, right? Get called away from you, right?
So at some brokerage firms, and probably not all of them, but at some brokerage firms, you can call them up and say, hey, I'm getting assigned on these shares, but I don't want to sell these shares. So here's what I want to do. I'm going to buy new shares and I'll take assignment on those new ones. And there's a lot to that, and you can goof it up unless you're very, very prepared. So what I'm saying, I just want to caveat this so people don't make a mistake. If you're playing that game where you're selling a covered call on a stock that has a very low cost basis for you, first thing you need to know is learn about this thing that I'm talking about. I mean, I cover it in the book. If the book's out by then read that chapter. But make sure you know about that in advance so that you can jump on that right away, because the clock is ticking.
And what's that? Does it have a name?
Yeah, it's the
covering your assignment kind of stuff.
Yeah, I mean, it's just picking your cost basis is what we'll call it a lot. And so basically, it's kind of good to know that phrase, selecting your cost basis. But really, I mean, if you're using a good options friendly brokerage firm that allows for this, they've probably done it before. You can just explain the situation in regular words, kind of the difference between how we used to have to Google things and now with ChatGPT. Hey, just say it in regular words and misspell half of them. ChatGPT is going to figure it out.
Yeah, pretty amazing. Yeah. Yes. Okay. So it's too nuanced to give an exact set of rules.
Um, well, kind of, because we want to try and not get assigned. You become late, I mean,
Right.
that's step one.
So, okay, let me frame it
Okay.
this way.
Okay.
We have 1,000 shares of Google, of which gigantic capital gain. We don't want to let it
Yeah.
go. We'd like to avoid assignment, like you say.
Yeah.
Uh, and um, should if we sell a covered call against it, should we use a stop loss on that covered call? So if really the stock starts to take off, which we're happy because we own the stock, but we don't want to sell it, do we cover it? Is there like a threshold where you say that's enough? Number one, and then number two, on the other side, if the stock drops and then the option drops, and you want to cover your short call, is there, like, I've heard, like, if you make 50% on it, you just cover it, or just if it's far enough away, you let it expire. Any rules around that?
Yeah. It's very,
I'm really asking you toughies,
I
man.
know.
Yeah, I guess there's so much nuance to it.
Yeah, I mean, to do it right, there is, like, I mean, I've heard people say, oh yeah, real easy. Oh, if this happens, do this. If that happens, do that. Oh, that's all you need to know. But I mean, it's not. I mean, it's like saying, oh, you want to learn how to drive a car? Well, there's a steering wheel, there's the gas, there's a brake. See you later. I mean, if you want to be good at anything, the more effort you put into it, the more you get out of it. So, um, a couple nuances that you talked about. One is what to do if the stock goes up. You're not likely to get assigned if the calls are out of the money. In most cases, it'd be foolish for somebody to execute an option that's
Right.
out of the money. So, you don't have to worry about doing uh, a damage control adjustment if it stays out of the money. Once the option becomes in the money, if you're new to this and you want to set a quick, fast rule, as soon as the option becomes in the money, roll it up to a higher strike and out to a longer dated expiration. There's as quick and fast a rule as I can say for the largest use case. Now, on the other side, as far as taking half the profits if the stock goes down or if time passes, I think it's better to be a little greedier.
Okay.
Because as time continues to pass, if it's close to the money, they just get bigger, and you just make more and more. And so what you really need to do is, if you're thinking about closing that option, say at 50% of the, of the maximum profit, are you going to roll that to a different option? Well, if you're going to roll that to a different option, is it actually a better one? So you have to look at the theta. You have to look at the annualized return and see which one has a better theta, which one has a better annualized return. You have to look at the implied volatility. And most of the time, the answer is going to be, no, I should keep this on longer. I should hold this and squeeze more out of it. Now, that being said, it's almost always wrong to hold it until expiration, except when we're talking about very, very illiquid options, and then you have to hold until expiration. What I do, here's my system for a lot of my covered calls, cash cured puts.
All right.
I turn.
Here we go. This is what I want to hear.
Yeah. Okay, here we go. The secret sauce. Ready?
Here it is. Yes.
All right. So I will decide my objective. Do I want to skate and just keep the premium, or do I want to get assigned? I'll put on the option. And as soon as I put it on and get filled, now I have the trade on, I will immediately put in a good till cancel order to buy that option back at 3, 5, or 10 cents. It depends on the liquidity of the option and if it's above or below like $5 or so. And then I wait, because the way you make money from covered calls and cash secured puts is time passing. And
Right.
people who are swing traders or who trade very active, like breakout strategies, even option strategies, it's a different way to think about it. The graph is not a
Right.
graph of stock price; it's a graph of time passing. We just
Right.
wait for theta, wait for theta, wait for theta. And if the stock makes a directional move and delta delivers me a good profit on my option, then okay, it'll hit my good till cancel order and then I'll just roll. What typically happens though is I look at them every day and I make sure everything's going according to plan. But sometimes once it gets down to a low level where the theta on that option is no longer as good and I can roll out to a better theta option, I will cancel that good till cancel order. And I'll do a roll right then and there to always be capturing the highest theta option that I can. I'm going deep today, Eddie.
Okay.
I'm going deep.
Yeah. Can you explain theta?
Yeah.
I know delta. Tell me what theta
Yeah, I
means.
know. I'm getting into like option nerd
I know
nitty
we're getting
gritty.
in the
Yeah.
weeds here. I know.
But I love it. I love it.
Okay. Awesome.
All right.
Awesome.
So the thing about options is as time passes, they lose a little bit of value. And, you think about it, like that makes sense. Like if if I'm going to buy an insurance policy to insure my car, if it's for 6 months, then, I don't know, it's $2,000 or whatever it is. My wife pays those bills. I have no idea how much it costs. But if you're renting a car for a week and they sucker you into the extra insurance, it's not going to be $2,000 because it's only for a week. You might be a couple $100. The amount of time in that insurance contract matters. If there's just a little bit of time, it's worth a little. If there's a lot of time, it's worth a lot. So
the amount of risk over the amount of time.
bingo. So that's what theta measures. As one day passes, how much does that option lose if I can just isolate the time criterion?
Interesting. Okay.
I love this. I love getting into the weeds on this options nerd stuff. It's what I do.
Yeah. I'll have to give that one some thought and do some research on that one. So how did you learn all this? Did you have a mentor?
Yeah, I think any person who's made it in trading has had at least one mentor. I guess I kind of had a couple, but my main one was a guy named Gino, who, when I said earlier that I was a trader's assistant, I was his assistant.
Okay.
And between him and another guy named Mike, they had different styles. One was very understated. One was your, stereotypical trader who's like, you make a mistake and he's going to scream at you. And so for
a lot of that on
a
the
lot
floor,
of that,
I'm sure. Yeah.
So between the, like, he's not saying anything, I hope he's not pissed off, to the, fear of being yelled at, I would have to make sure that I was right every single time. If he said, hey, what's the delta on my position right now at this underlying price, I'd have to know it exactly within the millisecond, answer immediately.
Wow.
And he would probably know it too. And if it was wrong, he'd say, wait, did you punch in this one trade? Yes, I did. And I would have to know, oh, that trade would have affected the delta by this much. So like, I would have to know these things when I was a trader's assistant, because these are the things you need to know when you're a trader. And so when I became an options trader, I was just already in the habit of knowing, hey, I have to know what the delta is on every single trade, on my net position. I have to know what the theta is. I have to know what the gamma is. And in a way, because like if you're a futures trader, you might just trade one futures month. You could be a spreader and do 2 or 3, 4, but that's it. With options, I would have positions on in hundreds of contracts, and no human can just know how many contracts.
Of
Yeah,
course.
nobody can know all what every single position is. So it's kind of ironic, but it makes sense when you think about it. When we reduce this massive position of hundreds of strikes and tens of thousands of contracts down to delta, gamma, theta, vega, now there's only 4 things I have to think about. It just puts it all into very, very useful information baskets.
Interesting.
So they're more.
So those are your controls when you trade options.
Yeah, controls is a great word for it.
Those are your dials.
Yep.
Interesting. And you discuss this in the book?
Yeah. The book is designed for anybody who has never even heard of options. I kind of started at the beginning, but if you want to be great at it, which is the purpose of the book, I go very, very deep into all this stuff, but I do it in such a way where it's not overwhelming. It's not just fancy out.
Because I can imagine that someone watching this who really doesn't know that much about options, our conversation might have been a little overwhelming. We've been all over the place, which is my fault. I take responsibility. So first, tell me about market taker. And somebody doesn't really, they know a little about the stock market, but they really don't get options. Is that market taker a good place to learn?
Yeah. I mean, our sweet spot is people who have at least gotten some exposure to options.
Okay.
We have worked with people from the very beginning, like, let me tell you what a call is. And honestly, even though we tend to work with people who have some knowledge, I love working with people right from the beginning because then they don't have bad habits. They didn't hear some weird thing from some goofball on YouTube.
Well, I mean, I think about after COVID, I mean, the options volumes surged. A lot of people had no clue what they were doing, especially with the meme stock, the options on the meme stocks and like GameStop. That was crazy. A lot of people got blown out very quickly.
Yeah.
So some people got rich too.
Yep. It's like anything else, like trading. I mean, they say, what do they say? 95% of traders lose or something like that.
Yeah, over 90% of day traders lose money.
Yeah.
And blow up at least 3 accounts.
Yeah. And I would say that's probably very similar numbers for option traders too, which, I mean, it sounds like, oh crap, well, it must not work, but it does when you take it seriously. Like a lot of people, I mean, open restaurants and fail because they're like, oh, I like to eat pasta.
Yeah, I like food.
Yeah.
I like to eat.
That means I should be able to run a great restaurant and make money. Well, no. You get out what you put in. And I guess that's what market taker mentoring does. We work with people, whether they're beginner, experienced. We even work with professional traders as well, and get them to that next level. We have group classes as well as one-on-one coaching, and literally whatever your experience level is, we can get you to the level you want to be.
Awesome. So where are the best places to find you, to learn about, to hear what you have to say, and to learn about your programs?
I'm going to give folks 2 choices because there's kind of 2 things you can do with options. You can do the investing wheel thing, which I write about all the time on my Substack, which is also kind of co-branded with my podcast, Wealth Building with Options. Wealth Building with Options. And that's my podcast, and that's also my Substack. You can find me there if you're an investor, want to get good at the wheel.
Wealth Building with Options. Got it.
And then for active option traders, markettaker.com is where we do one-on-one coaching.
One-on-one. So somebody could come to you who Like I gave you the example, the person who inherited Google, they could come to you with their portfolio and say, how can I maximize this portfolio? And you'll work with somebody one-on-one.
Absolutely. That exact scenario has happened multiple times, because that's an important one. You know, you have a concentrated wealth position in one stock and you've owned it for a long time. Like, you can't just wing it. Like, you should get some professional help with that. I know I would.
Right. Definitely. Especially if it's you know, an enormous amount of money. If it's just sitting there and you're passive about it, it may do well if you like the stocks, but there's a way to optimize it.
Yep. Yep.
You could probably get a lot more juice out of it.
Yep. A lot more.
Interesting. Awesome. Dan, I really appreciate the conversation today. I mean, we barely scratched the surface on some things. I'd love to do this again. And we can, now that we know each other a little bit better, I think we can like try to focus on one topic next time. But instead of, that's my fault. I tend to be all over the place.
Same.
Awesome. How about YouTube?
Oh, yeah. Our Market Taker Mentoring YouTube channel. I put out daily videos on YouTube, just talking about the market. It's a great free way to, get some insight that maybe you don't get from just looking at the regular news.
Awesome. Excellent. Dan, I want to thank you for coming out today. I really enjoyed this conversation. I really would like to do this again.
Yeah, thanks, Eddie. This was a blast. I'd love to.